Hey everyone, Brian Bogner and Greg Towner here with Parallel Portfolios. And if you remember for the last video that we did, this is a special video that we're doing here. One of the things that we talked about is there is some significant secular changes going on in the markets right now that we're seeing just broadly across the board. And we've been saying this a lot lately, the last 10 years is probably not going to look like the next 10 years. And so the question that we are asking here is your portfolio ready for the next 10 years of what's taking place right now? So we're going to be talking a little bit about those changes, a little bit about, managing through that and what we're doing and things like that. So let's go ahead and get started. Greg?
Yeah, thank you, Brian. I mean, we thought this was a good chart to start with. This looks at what the yield is that's provided by a diversified portfolio, half in stocks, half in bonds. We can see through the 1990s, 2000s, you could easily get 4 or 5% even at times generated income off your portfolio, and it was nice for retirees to live off of that. But now here we are after a decade of decline in this line. Very minimal income is being provided by a typical diversified portfolio, so that creates problems for a lot of investors. So why is that, right? I mean, it's mostly about the interest rates. I mean, this is a long-term chart going back to the 1940s of the U.S. 10-year bond. We're roughly at the same rates now that we were back in the 1940s, 2% or lower. We've seen 40 years straight of declining yields. So no longer do investors have the higher yield potential. They also no longer have the tailwinds of the rising bond prices behind them. Potential major shift here.
Yeah, and so not only we think about that, that 60-40 or 50-50 portfolio, they call it the bulletproof portfolio, right?
Yeah.
The whole idea is that as interest rates were going down, at least that bond piece, you were getting something happening there. But, if rates start to rise here, which, we're not saying rates are going to rise, they can stay down at these levels for a long period of time. So there's not a lot of return, but if they start to rise, that safe part of your portfolio, right, that other 40 or 50%, may not be as safe as you think, right?
Right, and even if they don't rise and they just stay at these levels, you're not hardly getting any income. So either way, it's a tough spot for fixed income.
Right.
Tied in with fixed income and interest rates often is inflation. Now, this is the consumer price index over the long term. We can see here for the last decade plus that for the most part, we've been bouncing around at very low levels other than the occasional periods around recessions. But we all know that here recently, we've seen some jump up in inflation, whether that's just due to some of the logistical and supply constraints, or whether it's something more longer term and secular. Well, time will tell, but we think that the next 10 years, inflation could be higher and could look much different than it has over this last 10 years.
Yeah.
And so when you think about inflation, what's one of the main asset groups that you think about? Hard assets, commodities. Now, this is a long-term chart of commodities. We saw that it increased all the way into the financial crisis, but now for more than 10 years, commodities have been declining. But look at that. It looks like the downtrend maybe has been broken. We've seen a jump up in oil and agriculture, some other areas that we've been gaining exposure to. It looks like the decline in commodity prices may finally be over. So let's look at commodities compared to US large cap stocks. We all know large cap stocks, particularly in the US, have been the winners the last decade. This chart, as the black line is rising, US stocks are outperforming commodities. And so we can see now that we're at a typical point in the trend where historically over very long time periods, it's kind of died out. That doesn't necessarily mean US large cap stocks are going to decline on their own. What it means is there's the potential here for commodities to start outperforming those US stocks. And it's at a point where that may happen over a longer term period.
And I can tell you, when I see statements from some of our competitors and things like that, client account statements and things like that, most investors as a whole are very underweight hard assets and commodities right now, right? It's not been a great place to be. So they've been extremely underweight them right now. And what are we seeing? We're clearly historically at an inflection point here. Speaking of stocks, right? We haven't even talked about stocks up to this point. We've been talking about other asset classes. So let's take a few minutes and talk about stocks. And one of the things that we look at we look at the difference. There's value stocks and there's growth stocks. And I'm not going to get into all the intricacies of why we have value and growth and things like that, but there's two very different styles in terms of how stocks are classified. And what happens over time is there are periods where growth outperforms and there's periods where value outperforms. Okay. And in here, okay, if the line is rising, value is outperforming growth. If the line's going down, like we've seen here really since 2007, 2008, growth is outperforming. We have had a very long period here where growth has outperformed value. Well, what's happened? We're near these inflection points, just like we were back in 2000. Yeah, 90s growth, tech stocks, right, outperformed. Same thing, really, over the last 10 years, it's been large cap technology names that have been the big winners. That we're seeing that begin to change here a bit. So,
it feels a bit like,
go ahead.
Yeah, it feels like a bit like deja vu from the beginning of our career there, doesn't it?
Right, it absolutely does. And again, most portfolios that we see are extremely overweight in large cap growth stocks. So, where's that value exposure? Where we've not seen it in a lot of other places currently. So there's value growth. Another thing we look a lot at is international versus domestic, right? Over the last 10 years, the best place to be has been the United States, without a doubt, in the stock market. Okay, but that's not always been the case. I mean, the 80s was actually great. So in this case, the purple line is international stocks, right? The orange line is domestic stocks. Well, the 80s was a great year for domestic stocks, but guess what? International killed it in the 80s. 90s, completely different story, right? It flipped. So that's a 10-year period. Domestic very much outperformed international. First decade of the 2000s, international outperformed. Now you had a big outperformance here going into the Great Recession there in 2008, but even after that, international still outperformed. Over the last 10 years, 2010 to today, domestic is outperformed. Now I'm not going to say over the next 10 years international is outperformed, but we see these periods where one is outperforming that. Again, a lot of the statements that we look at from some of our competitors and some people that don't invest with us, very little international exposure right now, and we could be at another rotational kind of inflection point going on there. All right, and lastly, last but not least, right? Taxes. So one thing that I think it's important to note, and this goes back to the 30s. So the orange line is the top income tax rate for the highest bracket, and the purple line is the lowest income tax rate, right, for the lowest bracket. So, but the point is we have been at a low in tax rates, okay? And with the amount of money that the government is spending in these infrastructure plans and stimulus plans and all these things that the government is putting out right now, there's a good chance that we're going to see higher taxes because these things are going to have to somehow get paid back. And so, how does that affect your portfolio? And Greg, I know you've got some good stats around portfolio turnover and things like that. Why don't you share that?
Yeah, I mean, when you look at turnover of a portfolio, that's very indicative of the tax hit that a client might incur. That the average mutual fund out there has a turnover of around 63% historically. If we look at our typical portfolio, its turnover has been around 35%, so much lower. And so that results in typically a lower tax hit for an investor.
Yeah, we see a lot of turnover in other accounts, and you've got to manage, you've got to be very tax sensitive in managing this, because that ultimately is the return that you get. It's your after-tax return that you get. And you could have two strategies return 10%, but one could be very different from a tax standpoint to the individual investor. So taxes, we believe, again, we're not trying to predict anything. We're just seeing some rotational and changes, and we believe that going forward, taxes could potentially be higher. So in summary, that 60-40 portfolio, 50-50 that was called a bulletproof for, we think it's no longer bulletproof based on where interest rates are today, based on a lot of things, but especially that interest rate piece and that bond piece is probably not as steady as it was in the past. There's many secular shifts going on, a lot of different things changing all at the same time. I mean, we've talked about commodities, we've talked about styles and stocks, we've talked about taxes, we've talked about inflation, we've talked about a lot of different things, and it's all kind of happening right now. Interest rates, of course, multi-decade downtrend is like I'm not saying interest rates are going to skyrocket and go up from here, but they can't go lower. I mean, yes, you could have negative interest rates. I still think that's extremely, extremely unlikely here in the United States. How are you hedging your portfolio for inflation, right? We talked a lot about hard assets, commodities. It's been so out of favor, but inflationary, again, all that money, right? Too much money chasing too few goods. There's a lot of money getting put in the economy right now that is possibly inflationary, right? So what is your hard asset strategy? How are you hedging for that, right? We talked about rotation, value versus growth, international, domestic. How are you managing through these things? And of course, taxes. So what I can say is, obviously here at Parallel, we are planning for this and we're managing through this. If you're not a client of ours, go to your advisors, mention these things, say, hey, there's some stuff going on. What are we doing? What's the game plan? How are we, if this happens, how are we going to respond to this and respond to that? It's very important that you have it. And if they don't have an answer for you, give us a call. We're always here to answer any questions that you have. So thank you so much for listening and have a good rest of your day.